Have you ever been trapped at, like, a cocktail party or maybe some local networking event, and you end up totally cornered by that one real estate investor?
Oh, man, I know exactly the type you're talking about.
Right. You know the type. They're, like, swirling their drink, leaning in, and just bragging to anyone who will listen about how they sold a massive commercial property and paid absolute zero in taxes.
Yep, the classic tax-free 1031 exchange brag.
Exactly. It's like the ultimate real estate cocktail party flex.
It really is. And, it sounds incredible. The idea that you can just wave a magic wand, invoke some secret tax code, and make the IRS completely disappear.
Yeah, it sounds great, but here's the thing. That investor, they are dead wrong.
Completely wrong.
We've been looking through a really fascinating stack of strategy notes and internal materials today from commercial real estate veteran Michael Linton.
Yeah, his methodology really takes a sledgehammer to this exact myth.
It totally does. And for context, you should know he is a major veteran in this space. He's the CEO of Linton Global Partners and the managing broker of Linton Global Solutions.
Right, he's been doing this for almost 4 decades.
Exactly. So the primary mission of our deep dive today is to unpack how a 1031 exchange actually works.
Because, spoiler alert, it is definitely not a magic eraser.
No, it's not. But it is a massive, carefully engineered wealth-building tool, but only when it's used correctly. So what does this all mean?
Well, it means we need to start by looking at exactly how the Internal Revenue Service categorizes this transaction.
Right, because the IRS isn't known for just letting things slide.
Not at all. The IRS is exceptionally clear on this point, even if the guy at the cocktail party isn't. When you execute a like-kind exchange under Section 1031 of the tax code, the gain is tax-deferred.
Deferred, right, not tax-free.
Exactly.
Right.
Not tax-free, tax-deferred. The tax bill is entirely postponed. It is absolutely not erased.
Postponed. Okay, so if the IRS is just hitting the pause button on your tax bill, we really need to understand the mechanics here.
Right, like how they actually keep track of what you owe them.
Yeah, I mean, they aren't just taking an investor's word for it, right? Like, hey, I'll pay you later, promise.
Definitely not. The IRS has a very specific, mathematically rigorous mechanism for tracking that invisible tax debt.
Okay, well, lay it on me.
It all revolves around a concept called basis, or, more specifically when we are talking about a 1031 exchange carryover basis.
Okay, let's break that down, because basis is one of those accounting words that immediately makes people's eyes glaze over.
Oh, for sure. It sounds super technical.
It does. But looking through these notes, it's clearly the entire foundation of Michael Linton's strategy. So how does adjusted basis actually work?
Think of your adjusted basis as your property's ongoing scorecard for tax purposes. You don't just look at what you paid for the building on day one.
Okay, so it changes over time.
Exactly. Your adjusted basis is the original purchase price, plus any capital improvements you've made to the property over the years.
So, like, if I put on a new roof.
Yep, new roof, or say you completely repave the parking lot, you add that cost to your basis, but then you have to subtract the depreciation you've claimed over the years.
Wait, hold on. Subtracting depreciation.
Mhm.
I'm confused. I mean, I always thought wear and tear was a bad thing.
That is a great question, and it's really where a lot of people get tripped up.
Right, because
Yeah.
why does claiming depreciation change my scorecard and, like, make my tax bill worse when I eventually sell?
Well, the IRS allows you to take a tax deduction every year for the presumed physical wear and tear on your building.
Okay.
It's a phantom deduction. You didn't actually write a check for that amount, but it lowers your taxable income right now.
Oh, nice. I like that part.
We all do. However, the government isn't stupid. If you sell that building 10 years later for a massive profit, you've just mathematically proven that the property didn't actually lose value.
Right. It gained value.
Exactly. So because you claimed all those deductions over the years, the IRS lowers your basis.
I see.
A lower basis means a wider gap between your scorecard and your sale price, which equals a much larger taxable gain.
Oh, okay. That makes sense. So your adjusted basis is this continually shifting number. It's the purchase price plus the improvements you made minus the depreciation you claimed.
You got it. Now, in a normal taxable sale, when you cash out and then eventually buy a new property, your basis on that new property resets.
Resets to what?
It becomes whatever new purchase price you just paid.
Okay, simple enough.
But in a 1031 exchange, that reset doesn't happen. Instead, your old, lower adjusted basis literally carries over and attaches itself to the new replacement property.
It carries over.
Yeah.
Wow, so you are basically dragging your old tax history, like all those years of depreciation, right into the lobby of your brand new building.
Precisely. What's fascinating here is how the government gives you this very clear, very logical line of sight. Well, they are perfectly willing to let you avoid paying the tax check today. But by forcing you to carry over that old low basis into the new property, they effectively embed your eventual tax obligation directly into the math of the new building.
Oh, wow.
Yeah, you're getting an interest-free loan from the government equal to the tax you didn't pay today.
Which is huge.
It is. That allows you to keep all your equity actively working in the real estate market. But make no mistake, the government knows exactly where that money is hiding.
Okay, let's unpack this, because when you phrase it like that, it really reminds me of doing a balance transfer to a 0% APR credit card.
That's actually a pretty solid analogy.
Right. Like you didn't magically make the debt disappear. You just moved the entire balance to a new card and delayed the due date.
Exactly.
But in real estate, your property is ideally appreciating in value.
Yeah.
And you're continuing to take more and more depreciation every single year.
Yep, you are.
So if the invisible bill is just getting bigger and bigger, aren't you just building a massive tax time bomb for yourself down the road?
That is the exact danger. It really is a time bomb. And to fully understand the stakes of that bomb, we need to move away from the theory and look at the actual numbers.
I agree. Let's get into the math.
The sources from Linton Global walk us through an incredibly illuminating real-world example that shows just how large these figures get, and very quickly.
Let's put the listener in the hot seat for this one. Imagine you're the investor.
Perfect. Okay, imagine you buy a small retail strip center. You bought it years ago for $500,000.
Okay, $500K. Got it.
Over the years you own it, you claim $150,000 in depreciation deductions on your tax returns.
Taking those phantom deductions.
Exactly. Eventually, the neighborhood improves, the market goes up, and you sell that exact same strip center for $1 million.
Okay, so I doubled my money on the top line. $500,000 purchase price, sold for $1 million. I mean, I'm feeling pretty good about myself right now.
Oh, you are feeling great. But now let's look at the math if you just do a standard taxable sale.
The bad news.
Yeah, here comes the bad news. First, your CPA calculates your adjusted basis.
Yeah.
Original cost of $500,000 minus the $150,000 in depreciation you claimed.
Right.
That means your adjusted basis, your scorecard, is now only $350,000.
Wow. So because I took that depreciation, the gap between my scorecard and my $1 million sale price is massive.
Exactly. You sold for $1 million. Your basis is $350,000. That means your total taxable gain is $650,000.
Ouch.
And here's the kicker. That gain isn't just taxed at the standard capital gains rate. It is a mix of capital gains and what's called depreciation recapture.
Depreciation recapture. That's the IRS clawing back those phantom deductions we talked about earlier, right?
Exactly. They gave you a tax break assuming the building was wearing out. You sold it for double, proving it didn't wear out at all.
So they want their money back.
Yep. They want those deductions back, and they tax that specific portion at a higher rate. If you, the investor, cash out and walk away, that entire $650,000 is exposed to tax in the year of the sale.
Which is just a devastating hit. I mean, depending on my specific tax bracket and what state I live in, I could be writing a check to the government for $150,000, maybe even $250,000, just wiped out.
$250,000 of your hard-earned equity vaporized.
Painful to even think about.
It is. But let's rewind the tape and put that exact same transaction inside a properly structured 1031 exchange.
Okay, let's see how the pros do it.
You decide you want to buy a bigger property. To do this, you have to hit strict IRS deadlines. You must identify potential replacement properties within 45 days of selling.
Okay, 45 days.
And you must completely close on the new property within 180 days.
Wait, hold on a second. If I have 45 days to shop around, can I just take that $1 million in cash from the sale, park it in my high-yield savings account, and then wire it to the new title company when I find the right building?
Absolutely not. And this is a crucial mechanical rule that catches so many people off guard.
Oh, really?
You cannot touch the money. If the cash from the sale hits your personal bank account for even 1 single second, the IRS considers it constructive receipt.
Constructive receipt. That sounds bad.
It's very bad. The exchange is instantly dead, and you owe the taxes.
Oh, man. So how do I actually buy the new building if I literally can't touch my own money?
You have to use what is called a qualified intermediary, or a QI.
A QI.
Right. The QI is an independent third party. When you sell your strip center, the buyer's funds go directly to the QI, who holds them in a secure escrow account.
Okay, that makes sense.
When you are ready to buy the replacement property, the QI wires the funds directly to the closing table. They act as a total shield between you and the capital, preventing constructive receipt.
Okay, so the QI is my shield. I follow the rules, I don't touch the money, I hit the deadlines, and I reinvest the full $1 million of equity into a new, bigger property.
Yep, you get it perfectly.
So I assume that means I pay zero tax today.
Zero tax today. You preserve the entire $1 million. But remember our conversation about carryover basis?
Oh, right. The invisible scorecard.
Exactly. Your new $1 million property doesn't get a nice, clean $1 million basis. The basis of your new property is reduced to reflect that $650,000 of deferred gain you just brought over from the old property.
It's just following me around.
Yep. And all of this math, like every single penny, has to be meticulously tracked for the IRS on a very specific document.
What's the document?
It's Form 8824, the like-kind exchanges form.
Form 8824. So this isn't just a gentleman's agreement with the IRS.
Not at all. Form 8824 is where you report the properties, the specific transfer dates, and the precise values. It's also where you have to calculate if you received any boot.
Boot. Like the shoe.
B-O-O-T. In tax terms, boot is any non-qualifying value you received in the exchange.
Give me an example.
For example, let's say instead of buying a $1 million property, you bought a $900,000 property, and you asked the QI to just wire the leftover $100,000 to your personal account to buy a sports car.
I have a feeling the IRS isn't going to subsidize my sports car.
They absolutely won't. That $100,000 in cash is cash boot, and it is completely taxable right now.
Wow. Okay. So they catch everything.
Oh, there's also mortgage boot. If you trade down in debt, say your old property had a $500,000 mortgage, but your new property only have a $300,000 mortgage.
Right.
Well, the IRS sees that $200,000 reduction in your liabilities as a taxable gain. You have to replace both the equity and the debt to fully defer the taxes.
Wow. So Form 8824 ensures that your deferred gain is mathematically preserved, tracking every single dollar of equity and debt.
It's a tight net.
Because if I ever sell that new property down the line and I decide, not to do another 1031 exchange, all those deferred gains, all that depreciation recapture from the previous properties, it just comes crashing down into a single tax year.
There's the time bomb, the avalanche. If you cash out, you pay for every single exchange you've ever done.
So if the stakes are this high and the math is this unforgiving, how are institutional players actually managing this without stepping on a landmine?
Very carefully.
The materials we're looking at outline a specific methodology for handling this. With Michael Linton's almost 4 decades of experience in commercial real estate, his strategy is really all about what you do with that deferred tax over a timeline of decades.
Yes, absolutely. The notes frame this brilliantly by comparing 2 different types of investors facing that exact same sale.
Let's hear it.
Let's call them Investor A and Investor B. Both are sitting on that $650,000 gain we just modeled. Investor A gets intimidated. They decide to just cash out and take the hit. They pay the taxes, let's say it's $250,000, and then they take what's left, their after-tax proceeds, and try to reinvest it in a new property.
So Investor A is starting their next investment chapter with a significantly smaller pile of money. I mean, they only have $750,000 working for them.
Exactly. Now look at Investor B. Investor B uses a 1031 exchange. They reinvest 100 cents on the dollar.
They put the full $1 million to work.
Right. They don't sacrifice a quarter of their equity to taxes. Now, zoom out over 10, 20, or 30 years.
The compounding effect.
Yes. Investor B takes that preserved capital and compounds it. Because they have more equity, they can afford to step up from a small, management-intensive strip center into much larger institutional quality assets.
What does an institutional quality asset look like in this context?
We are talking about properties with national investment-grade credit tenants. Think of a standalone pharmacy or a major grocery-anchored center.
Oh, like the big chains?
Exactly. These properties offer stronger, more predictable rent growth, zero management headaches because the tenant handles the maintenance, and far better financing options from lenders.
That sounds like a dream.
It is. Investor B is compounding their wealth purely because they kept the government's hands out of their equity pool.
Right.
If we connect this to the bigger picture, a 1031 shouldn't be viewed as just a one-off tax play to save some cash on a single Tuesday.
It's a whole philosophy.
It has to be a long-term arc. It connects your acquisition strategy, your financing, your property management, and your retirement planning all into one cohesive wealth-building timeline.
Here's where it gets really interesting for me. We're talking about a timeline at ARC. You keep trading up, deferring the tax, rolling the bases over and over.
Yep, keeping the momentum going.
But if the strategy is to just keep buying bigger and bigger properties to avoid triggering the tax bomb, does the music ever stop?
What do you mean?
Wait, I'm just confused. If I die with a massive, multi-million-dollar compounding tax debt, wouldn't the IRS just come after my estate? How does dying magically solve the problem?
That is the ultimate question, and answering it brings us to the grand finale of 1031 strategy.
Okay, lay it out for me.
This is the single scenario where the phrase tax deferred actually literally transforms into tax-free. But you're right to be skeptical because it doesn't happen during the investor's lifetime.
So when does it happen?
It happens through the mechanics of the estate tax rules.
Tell me how that works. Why wouldn't they just raid my estate?
It hinges on a very specific provision in the tax code known as the step-up in basis at death.
Step up in basis.
Under current law, when an investor passes away and leaves their highly appreciated real estate to their heirs, the heirs do not inherit that low, heavily deferred carryover basis we spent all that time talking about.
They don't. What do they get?
The heirs receive the property with a basis that is stepped up to its fair market value on the exact date of the investor's death.
Wait a second. So if I'm the investor, from our example, and I do 1031 exchanges my whole life, deferring millions of dollars in capital gains.
Yep.
And I eventually pass away owning a portfolio worth $10 million.
Yep.
My kids inherit it, and their basis is $10 million.
Yes. Which means if your kids turn around and sell that entire portfolio the very next day for $10 million, their taxable gain is zero.
That is wild.
Decades of unrealized capital gains, decades of depreciation recapture, decades of deferred taxes from a lifetime of 1031 exchanges. It's all entirely wiped out for income tax purposes. The slate is clean.
That is unbelievable. It's really like passing your saved game to the next player.
Oh, that's a good way to look at it.
Right. They get to keep all your gold, all your weapons, and your fully built castle, but the game magically erases all your accumulated damage and wanted level. They just start fresh.
That's a perfect analogy. You keep the wealth, you drop the liability. And in the commercial real estate world, this lifetime strategy is affectionately known as swap till you drop.
Swap till you drop. I love that.
You continually defer taxes throughout your life, trading up, swapping out of management-intensive properties into passive income properties, and then you let the portfolio pass through your estate.
Leaving a clean slate.
Exactly. It permanently eliminates the deferred tax obligation for your beneficiaries.
That is an incredibly powerful mechanism for multi-generational wealth. But I definitely hear a but coming.
This raises an important question, and it's really the biggest caveat of all. This entire outcome relies strictly on current law.
Right, the law can change.
The step-up in basis is a specific legislative provision in the tax code. If Congress decides they need more revenue and they change the rules around estate taxes, or they alter how the step-up in basis interacts with 1031 exchanges, this entire endgame strategy could be upended overnight.
Which means you absolutely cannot just put this on autopilot and assume your kids are fine.
Absolutely not. It makes continuous, proactive estate planning utterly essential. You have to be ready to pivot, restructure, or change your holding entities if the laws change.
So, knowing the swap till you drop endgame is amazing. It's clearly the crown jewel of wealth transfer.
It really is.
But getting there, actually surviving the investment game to the very end without triggering the audit avalanche, requires flawless execution over an entire lifetime.
Spot on.
Which brings us to the actual implementation of this and the sheer danger of sloppy decisions.
This is where Michael Lynton's warnings in the source material really resonate, because people hear that guy yelling tax-free at the cocktail party, and they think it's just a simple, casual loophole.
That mindset leads to trouble.
Terrible, financially destructive investment decisions.
What kind of pitfalls are we talking about here?
The most common one is the ticking clock. Remember those strict deadlines? 45 days to identify, 180 days to close.
Yeah, that 45 days goes fast.
There are no extensions. Investors get so completely desperate to avoid paying the tax bill that they will vastly overpay for a terrible replacement property just to hit the deadline.
Oh, wow.
They buy a building with bad fundamentals or a failing roof just because it was available on day 44. They let the tax tail wag the investment dog.
Right. Buying a bad real estate deal just to save on taxes is still a bad real estate deal. You're just losing your money to the market instead of the IRS at that point.
Exactly. Or you see investors trying to get overly creative in ways the IRS explicitly forbids.
Like what?
Trying to exchange non-qualifying properties, like a personal residence or a family vacation home in Aspen, pretending it's an investment property.
I'm guessing the IRS doesn't love that.
The IRS will absolutely tear that apart.
And we have to bring it back to Form 8824, right? The paper trail. If you mess up the boot calculation.
Yes. The sources highlight that getting the math wrong on Form 8824 is one of the most insidious mistakes because it's a silent killer.
A silent killer.
Yeah. If you miscalculate your carryover basis or you fail to properly report shifting mortgage liabilities, you probably won't get caught today.
But they'll find it eventually.
Years from now, when you've done 3 more exchanges and the IRS finally audits the entire trail of documents, your entire deferral structure collapses backward, and you owe penalties and interest on all of it.
So if I'm hearing you right, this isn't a DIY project where you just tick a box on your off-the-shelf tax software on April 14th.
Oh, definitely not.
If you treat it like a casual loophole, you might end up over-leveraged, holding terrible properties, and staring down the barrel of an IRS audit that then unravels decades of your hard work.
It requires a highly specialized team. It requires your CPA, your estate attorney, and a sophisticated brokerage team working in perfect, simultaneous alignment before you ever even list your original property for sale.
And that is exactly the thesis we're pulling from these source materials today. In the notes provided from Michael Linton's team, the primary directive they give to clients is that you have to model the tax impact first.
First and foremost.
If you are listening to this and you're planning a sale of an investment property, you need to structure the exit correctly from day one. You can visit lintonglobal.com and 1031dealflow.com.
Right, highly recommend that.
By connecting directly with Michael Linton, you can get help aligning your immediate exchange strategy with those long-term, multi-generational estate goals we just talked about.
It's all about having the clarity to make these massive financial decisions with your eyes wide open. You have to fundamentally understand that you are managing a highly complex liability. You are not erasing it.
Let's bring it all together. What we've learned today completely shatters that cocktail party myth.
Yeah.
A 1031 exchange is not a magic eraser for your taxes.
No, it is not.
It is a highly regulated, incredibly powerful deferral engine. It functions essentially as an interest-free loan from the IRS that allows you to keep 100% of your equity compounding in the market.
Beautifully said. And when it is paired with disciplined, long-term strategy and flawless estate planning, it truly transforms today's taxable gain into tomorrow's compounding wealth for the next generation.
It is the absolute foundation of multi-generational wealth in real estate.
Mm-hmm.
But I want to leave you with a final thought to mull over, something to keep an eye on in the news.
Okay, what is it?
We spent a lot of time discussing the swap till you drop strategy and how the step-up in basis at death is the magic reset button for all those deferred taxes.
The ultimate cheat code.
But remember, that magic button exists entirely at the whim of the current legislative tax code. If lawmakers were to wake up tomorrow and rewrite that single piece of legislation, eliminating the stepped-up basis to capture more tax revenue, how would generations of real estate investors have to completely dismantle and rebuild their legacy strategies overnight?